how does one really navigate this fall? We are asking simple and straightforward questions to all our experts. Is it time to buy, sell, hold, or sit on cash? Now, with this entire approach of breaking the market down, I'm going to throw this to another market veteran, that's Nimesh Shah. He runs and manages one of the biggest AMCs in India, that is ICICI Prudential AMC. Fantastic to have you back. Thank you for joining us. Every expert has given us the reason and the rationale why markets have fallen. So I don't want to go there. But what I want to know and understand and perhaps bringing out for our viewers is that now the damage has happened. What is next?
See, we have been consistent in what we have been saying. Damage has happened. Valuations have become cheaper. So we are 20% down from where we were 1 week back. Right, so with 20% correction, what looked good or what looked average at 12,000 of index, at 10,000 of index, it looks better, right? And one has to now decide whether one is investing for 6 months or one is investing for 3 years. And when you say that you're investing for 3 years, this might create, whenever there has been a crisis, one has to take a call whether India survives a crisis or not. If India survives a crisis, I know there can be many problems in the next 1 month, 2 months, 3 months. But if you have got a view that this is a thing that will last for 3 months or 6 months or 9 months, the virus itself and the impact of that virus, overall on a 3-year time frame, if you're buying a relatively cheaper index level, you tend to make money. Look at where the average PE ratios are. Right? Even if you look at the broader PE ratios of a 2021 and we say that it is at 16, but within that 16, there are two parts of the market. There are 10 stocks which are expensive. There are 40 stocks which are very cheap. Based on 2021 earnings, it looks like they are available at a 12 or a 13 or a 14. Suppose the analysts are majorly wrong. They are not available at 12. They are available at 15. Then also it is a good valuation to enter. The fear is high, and we have always said when the fear is high, when the news flow is negative, one has invested in India, sentiments are bad. Whenever that is true and the flows are negative, already the FII flows are negative, right? FII sold in February, FII sold in January, FIIs are sold in the first week of March, and till now the Indian flows have held on, right? So till last week, I'm talking about till yesterday.
As for the last AMP data.
I'm talking about even yesterday.
Your funds.
Overall, we get a sense of what is happening in the market. Till now, the Indian flows are positive. Even if the Indian flows become negative and the market gets corrected further, I don't know what is going to happen in the next 3 days, 5 days, 10 days. But even if the market gets to correct further, if you're buying at the valuation levels that are there today, I think one will have a good experience with 3 years in mind.
Okay.
Don't come with 6 months in mind because nobody knows with 6 months in mind, but 3 years it can be a good experience for the investor.
The question I'm asking everyone is that if you're hungry, you have two choices. You can eat a pizza, instant gratification, quick gains, or you can cook your dal makhani, which will be pain first and gratification later. Is it time to start cooking the dal makhani, or right now you can also eat a pizza?
I don't know the recipe for a pizza in this case. We know only the recipe of a dal makhani. So I think that's the only option. There is no other option because there is no way of who can say, even if a stock has got corrected and we would love and we would be buying today as we have been buying since the last 5 days. ICICI Prudential Mutual Fund has been buying consistently over there as the markets are falling. ICICI Prudential, because our models are such that we start buying, right? So though we are buying, we don't know whether we are going to make money in the near term. But we believe at this valuations will make money over a 3-year period. That's what I'm repeating. So there is no option but dal makhani.
Okay. Right. So what we can do, Nimesh, is that we cannot predict where markets are headed in the short term. But we can look at historically when markets have fallen 10%, 15%, what have been the market behavior indicators?
Correct.
Two factors which as a fund house you use is fear and greed. Correct. And the volatility. So both those data points will just come up on your screen. My question is that this is where the ET now, the VIX indication is 35. We went to these levels in 2008. It is not 2008. Then why is volatility, both local and global volatility, reminiscent of 2008? Why is the price action so dangerous? It is often said that markets know what is coming next. So is the price action telling you something which we can't see today?
No, I think in a flow-driven market, which we have had, right, the market in the long term, if you see 10-year of the index, 10-year of the index, the earning per share growth and the price growth have been very similar. It is around 7.2%, 7.5% if you take a 10-year range, right? But in the short term, earning per share, if in a flow-driven market, if the flows are negative, in fact, you have not seen as much volatility as you could have seen because the Indian investor is held on. If foreigners are selling, and if you remember 2010 to 14, when I used to come to your channel, we used to continuously say, and we used to come and give out advertisements saying that 100% of our funds have beaten benchmark. Why were we able to say that? Because it was relatively easier to make money. I used to say it is relatively easier to make money because whenever there is a problem in the West and reaction in our markets, see, we were talking about decoupling economies and all. So whenever problem is in the West and our market starts reacting big time because foreigners are selling, every year used to happen. 2010 we had a up in the market, 2011 the markets were down, 2012 the markets were up, 2013 the markets were down. Why was that happening? Because the foreigners were selling or buying. Right? Again, foreigners have sold in the last 2.5 months, especially in the last 1 week also, and this is the reaction. Till now, the Indian investor has held his breath and he has been investing. But today we are seeing a 20% correction and one has to see the Indian investors' behavior. But the best time to invest would be, as we have always said, contra investing is what we believe in, that one of the indicators is that my balance advantage fund, there is an algorithm that we follow. Yesterday was 69% invested. Right? It can go from 30% to 80% levels of the market. As the market goes down, that index gives us an indication to buy more and we have to buy more.
69% invested in equities.
Yesterday.
Okay.
And today, it would be 70 to 73% invested. So as I am talking to you, the model in my office has already decided that we have to buy. Because at every drop, we have to buy. So today we'll be buying.
This is a proprietary indicator, Nimesh. It is derived on how market behavior has moved, and we are in extreme fear. Again,
Correct.
this is our proprietary indicator. Every time we've been here, if you bought stocks in 1 year, you've made money.
Correct.
So the sentiment is completely.
So again, I don't want to say 1 year, but I am reasonably confident that this indicator, what it shows, is working beautifully well. Whenever the market is in extreme fear positions and people have bought, they would make money over a period of time because the valuations are supporting it. Negative news flows is superb for making money in a medium term. I would not comment on the short term.
Okay, that's how the fear has moved. I'm again and again going back to fear. Market is about sentiment and fear. The fear is reminding of 2008, folks. This is not 2008. The point I think we are trying to.
I was in the same job. I was doing the same job in 2008 also. And the environment in 2008 was very, very different.
But you look different in 2008.
Come again?
Your appearance was different in 2008.
Yeah, I had some more hair on me. That's all. But I think 2008 also created, I lost a lot of hair in 2008. But I don't think we are anywhere near 2008.
Okay. Valuations, another thing which we can look at, right? That's the ultimate tourism. You have to buy sasta. Investing is about buying gold at the price of silver. This is just rough analysis when markets have fallen more than 10% historically.
Correct.
Some of it is borrowed data courtesy ICICI, Prudential, AMC. Some of this is what our research team has done. When do you think markets tend to bottom out in P multiples? What is that yardstick?
See, when it is a flow driven, when machines are deciding in the West how much to buy and how much to sell and when to sell, right? There is no, I don't want to comment on that, right? I don't want to comment on numbers because I don't know. Right? Nobody can know that what is the bottom and when it will react because they are just reacting on they are getting redemptions. They are getting redemptions, they have to sell. Their model is telling them to sell, they are going to sell. They are not going to look at valuations. So it is up to the Indian investor whether we are going to buy at that point of time or not. Right? So I will be, till yesterday we have been buying, today also we are buying. Right? So I think there is a buying firepower still in India. We are able to get, either we are giving them a easy exit, right? One comment can also be that we have been giving the foreigners an easy exit to get out. But second thing, right now I feel that if we buy, it would be a good thing for the Indian investor that is buying what was available 20% expensive. So I'm not talking about a great return also. I'm saying can the market deliver a double-digit return from here is on a 3-year paradigm that looks more likely today than what it looked 1 week back.
Okay. 2007, when the world discovered a problem called subprime, Indian fund managers told me that India is decoupled. and it got decoupled for a couple of months. Subprime was discovered in August 2007. The market started correcting only in April or May 2008. Are markets telling you something which we are not able to imagine? We are celebrating decline in crude, but decline in crude also could be an indication of world coming down.
There is a direct correlation between crude prices and Indian market. Ideally, it should have been an inverse correlation, exactly. But look at data, there would be a direct correlation. Exactly. Again, I'm coming down to the flow-based market. Okay. In a flow-based market, when they do a risk-off in US, this decoupling and all started at that point of time. But we are an independent economy. We are an economy where 70 to 80% of the consumption happens within the country. So to that extent, economy-wise, we are independent of, or relatively independent than the rest of the world. That I am completely a believer of. But when 25% of your market is owned abroad, right, and they are going to, for them, it is a machine which is going to allocate into emerging markets and getting out of emerging. It has got nothing to do with India. One day they decide that their equity allocation, the machine decides that the equity allocation has to come down, emerging market exposure comes down, they are going to sell all the markets. It's not about India. So a machine is deciding over there. So there is no point in, so the markets cannot get decoupled. The economy can be decoupled, but the markets cannot get decoupled because of 25% of your, if is owned abroad, and they decide to sell, then the market has to correct if there are not enough number of buyers in India. It is our ability that markets have become cheap and Indian investors have the either models like us will invest as we are investing, and we will be investing if the market falls further, we'll be investing more, right? Either the models like that will keep investing, or Indian investors really become smart and see that the market is correcting, and they believe that India will survive in 3 years' time. And if India survives in 3 years' time, our economy and our businesses will do better and will follow a reasonable average earning per share. Remember, today's earning per share does not contain some of the private sector banks or the government banks which are coming back into profit. When you see that data, the market looks better. And that data will come in 2020-21, not far off. So I am quite, I think the market is quite, the value part of the market. There is one anomaly in the market which I still say, quality at any price has worked in the past. We have stayed away from quality at any price. So the average PE, when you are investing in a mutual fund, also see at what PE you are buying. If you are buying a fund at a lower PE, that is much better than buying a PE fund at a higher PE. Right? I would rather look at if it is a good, well-managed fund house with good investment capabilities, then buy a fund with a lower PE, which can make you money over the next 3 years. There are some sectors which have been completely ignored by the market. Say, will India, coronavirus or no coronavirus, will India need power? If India needs power, the biggest power company in the country, if it is available at a very single-digit PE with a very high dividend yield, and with earning per share is given that, as the government has already said, that the ROE has to be 15.5%. So as they make more power, they'll make more money. And we believe that the power companies which survive, and especially the biggest utility companies of the government, they will make a reasonable amount of earning per share growth in the next 3 years. Right? We can see the numbers on despite coronavirus. Business after business, can we estimate the earning per? We are the followers of earning per share. What are we paid for? Our customers give us fees for estimating earning per share over the next 2 to 3 years.
That's very simple.
That's why we are being paid. So we are doing our job. Keep your line and length. That's what we do. It's like cricket. Keep your line and length. At some point of time, the environment will change, and you will get the swing and you will get the wicket.
Will you bat on the front foot or the back foot?
I will bet for volatility. I will bet from my crease. I will not go out of the crease on the front foot. Neither will I go on the back foot. I'll bet on the. I'll look at the balls and accordingly play. and I will be prepared for volatility.
Can you define that?
I won't. Okay, if the market goes 1,000 points, if the Nifty even corrects 1,000 points more, will I be buying more? Yes, I'll be buying more, because I believe in 3 years' time there will be an India which will be robust, which will be able to manage it. This is a 3-month problem or a 6-month problem. I don't know how long, but it is definitely not a permanent problem on which India is not going to survive. So if the good companies of India are available at single-digit PE, I'll go and buy and stay for 3 years, and that's what I'll recommend to your listeners also.
So increase your SIP allocations. I mean, this is a time to increase your SIPs.
Increase your SIP or increase your systematic transfer plans can be worked out, where you can invest in the next month. Now I am not saying that invest over 3 years. Whenever I've come to your studio, I have always said balance advantage fund, so that you don't get much downsides. It has worked well for the investors. Even today as we are talking, last 5 years, balance advantage has done a good job for the investors. Right? So going forward, either it can be, I think the best way is to put the money in today, where we will decide based on volatility, decide on whether to increase allocation on equity or decrease allocation on equity. So balance advantage fund is, or otherwise I will say invest over the next 3 months.
Okay, fair.
Don't wait permanently. That it is not a 3-year call now. If with at the current valuation and with value stocks, even in Nifty 50, remove the top 10 companies and the market is quite cheap. The remaining 40 stocks are quite cheap. Metal stocks are quite cheap. Right? Metals are not going to remain permanently. And if you see the data from China, right, the pollution levels, there is something which measures the pollution levels in China, and pollution is increasing. That means the production is, our channel checks also indicate that China has started producing.
Yes.
Right? So there are parts of, and so though I won't comment on the virus part of it, I believe ultimately the world will survive.
Economic activity is normalizing in China is what we understand. I looked at a picture of a coffee shop where people are actually browsing and they're enjoying a cup of coffee. It may be shut down in Italian coffee store, but the Chinese coffee stores are opening.
Right. So will metals ultimately do well? It is available so cheap. Whenever you are bought cheap, whenever you are buying power plants at much lesser than their book value, you don't seem to go wrong.
Okay.
Historically.
My next question is that every time a reboot has happened, when TMT crash happened, infra made a comeback. When infra corrected, you had a comeback in consumers. When the taper tantrum started, small cap stocks, 2014, I mean, a great interview, I always recall you said, buy small cap stocks. Where will you thumb the table and say, buy this stock, buy this category, or buy this asset? Thumb the table and tell me.
We have started a thematic a fund of funds, which we decide which ideas we'll invest in amongst our stock. So what has that thematic fund invested in? That thematic fund has invested in infrastructure.
Okay.
Right? It has invested in opportunities fund. Right?
Special situation.
Special situation. This is the time to buy ICICI Prudential. I'll thumb the table and say that this is the time to buy. If you want to do allocation to equity, this is the time to buy ICICI Prudential Special Opportunities Fund.
Okay.
Right? Because there are problems right now that we face. Right? My business will face challenges. Your business will face challenges. But our businesses, both your business and my business, are going to survive, because we are adding value to the country. So is it a temporary problem or a permanent problem? So will I invest in infrastructure companies today? Yes, I will. Will I invest in metal stocks today? I will invest in metal stocks today. Will I invest in pharma stocks today? All these sectors have not done well in the last 3 years. Will I invest in those 3 sectors today? I will invest in those sectors.
Will you stay invested in telecom, which has worked like a charm for you, or telecom, the money has been made?
Telecom, we are remaining invested in, there are only 2 good companies. We had taken a big call in one of the companies.
I've been told that you've got $1 billion plus holding in telecom now.
That is our highest holding. Our highest holding is in one of the telecom companies, and we remain invested because we believe that the good times of telecom industry have just started. I can see your studio around. Most of the people right now are using data in your studio itself. Right? So and India is not paying so much. Today all of us are buying data very, very cheap. We are used to free. From free to, we were being charged 100 rupees. On an average, Indian telecom user was paying only 100 rupees. £1. People in West fall off their chair when they realize that we pay only £1 for unlimited data in a month. Right? It is too cheap. Right? We have to pay more for data. And when we pay more, the telecom companies will make much more money than we are making today. I still believe that telecom companies in India are cheap. When competition reduces from 13 players, you have reached 3 players, right? And so I believe it's a fantastic time to invest in telecom companies.
A logic given to us in last 10 years has been that liquidity is surplus, yields are coming down. Because yields are coming down, there is going to be a mad scramble towards emerging markets. Right now, yields are at a historic low, and they may remain like this. So how does one figure out what to do, what not to buy? When growth is coming down, yields are coming down. It's a strange situation, right?
In fact, it is relatively easier to get value picks. Investing was difficult at, say, a market of 12,000. Investment is relatively easier at 10,000. You require guts to do that. You require experience to do that. That in the past also problems have come up. And over a period of India can manage its problems. I think the basic thing is that do you believe, as an investor, do you believe that India will manage its problems or not manage its problems? Is India going to crash? That has never happened, right? We have got a 5,000-year history. I think we'll find solutions. So I am very optimistic. I know we face challenges. As businesses also we face challenges, but we'll overcome those challenges as a country